Good morning, everyone. Good afternoon. Welcome back to the Ideas for Your ISA 2022 event. Shortly, we'll be hearing from Thomas Patchett, equity specialist on the Japan desk at Baillie Gifford, about the Baillie Gifford Japan Trust. Baillie Gifford Japan is something of, I would say, growth stock royalty with a truly exceptional long-term track record. Over the past decade, it has returned at 264% in NAV total return terms, which is around double that of its closest competitor in the ASE Japan sector. The rotation from growth to value over the last year has seen the trust struggle, and it is down around 23%, and the shares have fallen onto a small discount. Thomas will be able to tell us how the managers are seeing opportunities after this sell-off and where they think the best long-term stocks are. You will be able to ask questions as ever. On the right of your screen, you should see a question box. If you could write your questions in there, you're all on mute. I will put those to Thomas at the end. We have a roughly 30-minute presentation and then around 15 minutes for questions. So with that, I'll hand over to Thomas.
Excellent. Thank you very much, Thomas. Just trying to, okay, sorry. Here we go. So yeah, thank you very much for your time today. As Thomas mentioned, I am a investment specialist with the Japanese team at Baillie Gifford, here to talk to you about the Japan Trust and why we think it presents quite an exciting opportunity in the long term. As you may or may not be aware, this was the first specialist Japanese investment trust launched in the UK 41 years ago, in 1981, making it older than I am. And over that time, it's been quite successful. There are now about just over £1 billion in assets under management within the trust. And it is managed by Matthew Brett. Matthew has been involved with the Japanese team since 2015 and took charge of this trust when Sarah Whitley stepped back and retired in 2018. And he's joined by Praveen Kumar, who you might also be aware of. Praveen is the fund manager for the Shin Nippon Investment Trust. And as Thomas says, despite what it shows on this page, it is actually trading at about a 5% discount because of obviously the weakness that we've seen recently in share prices. Just to set the scene for the next 30 minutes, I think it's important that you view this in the right way. And that is as a portfolio, as a collection of companies which we believe offer the most exciting, the most promising long-term growth prospects within Japan. Despite the name, it is not intended to be a play on the country, a reflection on the macro. We are not trying to predict macro or predict macro themes within this portfolio. So it is more just a collection of fantastic businesses which happen to be based in Japan. And to give you a bit of a feel for the funds, you can look at the top 10 positions on the right of that presentation. We think this portfolio gives you access to a whole host of different types of opportunities. The main one probably being internet. SoftBank Group is an obvious reflection of that. Rakuten, being the second, Rakuten is very much viewed as the Amazon of Japan. SBI Holdings, the pioneer of disruptive finance within Japan. This, as I say, is the biggest theme. We've also got exposure to robotics and automation, something which Japan is particularly strong at. And that comes through here, companies like Fanuc, which is the global leader in industrial robots, and Kubota, which is predominantly focused on smart farming and agricultural mechanization. And then we've also got exposure to other things like content and gaming companies that you can see from the likes of Sony here, and a little bit further down, just outside the top 10, Nintendo. I think gaming is another area where Japan excels on the international stage. As mentioned, this trust has been going for over 40 years now. And as Thomas kindly mentioned at the beginning, it's delivered very, very strong numbers throughout that period. So an annual total return in NAV of over 10%. And that is strongly above that of the index, so it's outperformed its benchmark despite recent weakness. And of course, all of the other ostensible game-changing events that have been thrown at it, man-made and natural, of which Japan has obviously faced more than its fair share. So that includes the financial crisis, it includes Japan's infamous bursting bubble and the 2000 earthquake, amongst other things. Key thing being here is that it has survived the test of time. The process and philosophy have remained the same, and it has been fortuitous through various different market environments. What's more important or more interesting is the changing nature of the underlying opportunity set. That has begun to change dramatically. And you can see here, after the 1990 bubble burst, it was mainly banks. When Matt joined the team in 2005, they were still had a stronghold of the index, still accounted for the lion's share among autos and other kind of conventional areas. But that's changed. It's far more dynamic now. There are more content companies, automation, robotic companies, gaming companies, tech companies of various different colors. What's more interesting is that there's even more dynamism and evolution and entrepreneurship occurring further down the market cap spectrum within the small and mid cap space, which is the area that this particular fund focuses on. So with that preamble, I'm going to shift gears and take you beneath the bonnet and explain to you how we do what we do. So the team, the process, and philosophy, which, just to highlight right from the get-go, is true of all of our Baillie Gifford Japanese strategies. It is a common glue across the board. The differences between the vehicles are mainly a reflection of what that vehicle allows you to do. So starting here with the team, as I mentioned, Matt and Praveen have ultimate responsibility for this trust, but it is very much a product of a team-based approach in terms of idea generation, research, and debate. And we think we're fairly resourced here. So as you can see, it's quite a large team. It's from marrying the stability from senior managers like Donald, who's been investing in Japanese equities for over 30 years, with the fresh thinking and challenge that some of our new graduates bring. And we have an annual graduate rotation program. So every single year we get new graduates fresh to the company or fresh to the team because they've spent a year or two on other regional or international equity desks at Baillie Gifford. And that's really important because it maintains dynamism within the actual team and the flow of communication across teams within Baillie Gifford. What's also less apparent here, but something which Baillie Gifford generally across all of our strategies highlights as probably being one of the biggest USPs of the company, is the high amount of cognitive diversity that we have within the team. We don't pluck people from the conventional routes that you might expect for an asset management house. We prefer people with fairly esoteric backgrounds, people that can bring something different to the debate. And so within we have four doctors, one medical, an author, a historian, a lawyer, computer scientist, and a whole host of other backgrounds. And that's really important because it allows us to attack an opportunity from multiple different angles. People applying different mental models based on their previous vocations and areas of study. And that allows us to think and to see things differently to Mr. Market. Just going on to the next slide here. In terms of the investment philosophy, a lot of this will be fairly common, what you'd expect to see. Similar to other Baillie Gifford strategies, we adopt a bottom-up, long-term, growth-orientated approach. We focus on the fundamentals, not on forecasting. Sorry, I'm just having a few technical problems here. One moment. Using the screen. Okay, here we go. So we focus on the fundamentals, not on forecasting macro events like geopolitics, interest rates, war. We don't do that. We don't do that because, one, we don't think we have any value add. We don't think we're better at anyone else at trying to predict this stuff. We think it's very hard to try and predict and get ahead of some of these things. And the other reason being is that we actually don't think it matters as much, or we think it matters less and less as time goes on. What matters more, what ultimately drives share price performance, is superior earnings and cash flow generation. So we focus on finding companies that present the possibility of delivering on that front, the possibility of delivering above average earnings. And the numbers that you can see, some of the charts that you can see below on that page, highlight that. And are effectively indicative of that approach. So turnover within the portfolio is very low, less than 20%. Active share is invariably above 80%. It's very different to the index. And these are the types of numbers, the types of things that you'd be very familiar with if you're aware of and familiar with other Baillie Gifford strategies. What differentiates us from other Baillie Gifford funds or strategies, the slight nuance, I guess, is that we adopt a bit more of a flexible approach to growth investing. So instead of subscribing or adopting the market definition of growth, which is arguably anything that trades as an optically high short-term multiple, and that obviously mainly applies to capital-light internet businesses, we think growth is or encompasses companies that operate or that can operate in any sector within the economy, as long as they present plausible pathways to doubling their share price over a 5-year period. Okay, so that could come from the stereotypical or often associated area of growth investing, which are or is in internet-related businesses, like, as you can see from the chart in the bottom right, M3, a provider of medical platforms, mainly within Japan and overseas. It's grown its top line at over 20% annually for the past 5 years. Or secondhand e-commerce company Mercari, which is another big position within the portfolio. That company's grown its top line by over 50% per annum over the past 5 years. These are companies where we would expect margin normalization, which could result or should result in a doubling in their earnings and hence a much higher share price on exit in 5 years' time. But it could also come from steady Eddie type stalwart businesses, companies with high brand equity, strong market share like Sysmex and Pigeon within that chart, that have grown at low single-digit rates but delivered strong share price upside by investing heavily in R&D, growing their market presence, moving into new verticals, new markets, and growing their margins and profitability, again, resulting in a higher kind of exit price in 5 years' time. But it could also include cyclical companies, lowly rated cyclical businesses like tire manufacturers Bridgestone or Tsubaki Nakashima, which is a manufacturer of balls, ceramic, steel, glass balls that go into ball bearings. These are companies where we see a pathway for margin accretion in the long term and improvement in through the cycle earnings, with the potential for multiple expansion. A lot of these businesses usually attract very, very low multiples, so any kind of pickup in profitability would undoubtedly result in a re-rating for some of these businesses. And then you've got your special situations, businesses like SoftBank, where you could achieve growth through kind of a double-barreled way, effectively, through two means, through an appreciation of the underlying assets, as well as a narrowing of the discount. There are a lot of Japanese businesses which trade at a significant discount to the sum of the parts. Now, adopting this kind of approach within Japan allows us to avoid forming preconceptions as to what growth is and where growth could come from in the next 5-10 years. It also helps us to create a naturally diverse portfolio, and allows us to effectively capture the full asymmetry of equity market returns by investing across different sectors in various different areas. And this chart on the bottom right highlights that. We've got M3, which I mentioned, online medical platform, Sysmex, focused mainly on in vitro diagnostics, so medical blood diagnostic equipment, Pigeon, which provides maternity and infant products. You might be aware of it with the Lancina brand. Personal Star Company, and GA Technology, which is an internet-based real estate business. Moving on to process. There are 3 stages to this: discovery, debate, and decision. The first, discovery, is where we try and come up with effectively new ideas. So this is the idea generating part of the process. Here we rely on fairly alternative sources of information, less on sell side, more on academia, conversations with private companies, conversations with our colleagues, our international colleagues, focused on similar types of opportunities, but in different regional markets. The next stage, debate, is where we try to understand, uncover and explore what we think are the most fundamental factors that will likely drive long-term share price performance, that will likely drive a better than expected earnings growth. And then finally, decision. This particular strategy, this trust, this is where it will depend on Matt and Praveen's conviction, either their joint conviction or one or the other, the conviction of either Matt or Praveen. Taking a bit of a closer look on or at the debate process, as you can see, that extends to the right. There are 4 elements to this. We break our research reports into 4 different areas. The first is opportunity. Here we are trying to assess the broader nature of the opportunity available to the company, whether it is a blue ocean opportunity. And that means trying to understand the industry dynamics, whether it's a fragmented industry or consolidated, whether the company is likely to face soft or formidable incumbents. We also want to try and get a bit of a handle on some of the broader structural changes that might occur within the industry. Is it going to be impacted by declining demographics or other environmental or technological shifts? We want to make sure that this company, because of what they're doing or what they're trying to do, is going to be on the right side of history. The second point is resilience plus. Here we are looking at more of the idiosyncratic factors related to that business and whether it can therefore capitalize on the opportunity available. We are looking for not just high quality businesses, but using Nassim Taleb's words, we are looking for anti-fragile companies that will actually become stronger through counter-cyclical investment, for example. And that means trying to understand various elements of the business. Their competitive edge, whether it comes to technological expertise, regulation, incumbency, the business model, the culture, and whether that's sustainable. We look at their finances, whether they could self-fund that growth or will rely on equity issuance, and whether they've been good allocators of capital in the past. And of course, management, and the importance of management will obviously vary depending on the maturity of the business. But all of these things are thought of holistically together to paint a better picture as to what this company, how this company is currently situated, and whether we think it will be well placed to capitalize on the opportunity. ESG is the next area. This is not prescriptive. We avoid a tick box approach here. Instead, what we're trying to do is look at what's relevant and material, those 2 key things, to the investment case. So that's obviously going to change depending on the nature of the business and the industry in which it operates in. So the kind of bog standard basic here is looking at the business practices, whether it is being run in a sustainable manner. The next, and this will be more relevant for some companies than others, is looking at the intent of management and the impact of their products and services. And then finally, we have upside. Here we are attempting to summarize everything that's been, all of the qualitative information that has been assessed so far, and put that into quantifiable numbers to try and quantify the kind of quantum of upside that is available based on the current trading share price. Here we look at our base, bull, bear case scenarios and translate that into numbers to see whether that does result in a doubling of our money over a 5-year period. Moving on, finally, just one page on ESG. As I mentioned, we incorporate that through this integrated question, which I highlighted in the previous page in the process, as well as through ongoing engagements with our companies. And we think that incorporating ESG in this manner, it will be better suited to be an accretive aspect, an additive aspect to our process, something that actually helps us to uncover future growth and future opportunities, as opposed to purely being a risk prevention mechanism. Looking forward, it's likely that we might entertain other generalities, other exclusions, or various exclusions to ensure that this fund does get to an Article 8 status. We do, and I think the main way in which we approach it, integrated into our process, should allow us to successfully apply for an Article 8 status when that opportunity presents itself. So moving on to the portfolio, currently we have 66 holdings, as you can see here, if you add them all up. These are all held for their own idiosyncratic, their own appealing reasons. As you can see, almost 2/3 of the portfolio has been held, or have been held for over 5 years. So not much changes from 1 year to the next. As I said, turnover is very less than 20%. And last year was no different. So despite the pickup in volatility, we haven't changed our stripes. Last year, there were only 7 new buys and 9 sells. So very much business as usual. This page might provide you with a better feel for the portfolio. So this is more of a qualitative representation of the thematic end exposure. So this is all a byproduct of the bottom-up process that we adopt. Our biggest exposure is to that internet space. That's about 1/4 of the portfolio. Companies like SoftBank and Recruit. Recruit is a company you're probably aware of. You might not know it, but if you've heard of Indeed, Glassdoor, then you've heard of Recruit. So Recruit is the company behind those two. It is quickly becoming a huge meta search engine thanks to the massive amounts of data that they've collected on individuals, and the fact that 250 million people access their sites on a monthly basis. Those aspects should allow, or we think will allow, this company to become a global leader in one-click recruitment, as it turns the recruitment process into something akin to e-commerce, buying something on Amazon, a one-click purchase. And we think they might be able to do that because of the efficiency they have been able to achieve in matching individuals, because of all the data that backs that up. It's a very cash-generative business. It's been generating over $2 billion of free cash flow on an annual basis, which it's been recycling into other domestic software-type businesses in a hope to kind of smooth out the volatile nature of HR-type earnings. Moving on, robotics and automation. That's excuse me, probably the next biggest area within the portfolio, about 15% of the portfolio. Fanuc, which I already mentioned, is one in the top 10. This is the global leader in robotics and industrial automation, with leading market shares, especially within China, despite local subsidies. And we think that labor shortages and wage inflation, interestingly, those two issues are cited as the biggest concern amongst CEOs, not COVID. Those factors might actually spur further growth and actually provide a boon to broader adoption of robotics and automation. Moving on, we also have B2B industrials, companies that benefit from that Japanese principle of Kaizen, or continuous improvement. Companies like Denso, which is a tier 1 auto supplier, has 20% global market share of xEV, so all forms of electric vehicle, electric motors and inverters. It's a big player in ADAS and HVAC technologies, which are going to be really important in EV cars. And because of the complexity of combining various components within electric vehicles, we think this company will become ever more profitable. A lot of the products and services they're selling to EVs are much higher margin than what they were selling previously to ICE manufacturers. Gaming. Japan has home to some of the best, if not the best, content companies in the world, such as Sony, So people often still view Sony as a manufacturer of TVs and electronic goods. It is actually more of a content company, so more than 2/3 of profits come from content. It has positions in three very attractive entertainment verticals. Gaming, it's the number one player because of the PlayStation. It's the number one player in music, music publishing. And it's also a big, big player, one of the biggest players within pictures. It's actually the only Hollywood studio that is not tethered to an OTT service, which is going to be very advantageous in the given the competition from streaming services like Netflix and Amazon. And it also has all of that hardware to provide direct to consumer access. And then finally, we have resources, Japan's Sogo Social trading companies like Itochu, and vertically integrated mining companies like Sumitomo Metal Mining, a company that's benefited hugely from the explosion of demand for rare metals, especially within batteries for data centers and for electric vehicles. Moving on to performance, hopefully what that previous page showed you was the fact that we have exposure to a whole host of different types of businesses, some benefit in different environments. We have seen probably the most extreme rotation in recent years, not even in recent years, in 20, 30 years. 2020 was a fantastic year for internet businesses, and they became huge winners and equally so the biggest losers in 2021. And that's no different here. Our internet and gaming companies have been hit severely over the past 12 months, whereas our exposure to energy, resources, auto companies, and finances is broadly benefited. And that helps, I think, because, as I say, each holding provides us with the prospect of doubling our money on an isolated basis over a 5-year period. But because we're agnostic to where we find growth, we naturally result in diverse portfolio that should benefit in multiple different environments. Taking a step back, generally, we are not so perturbed by recent market weakness because of, one, our long-term focus, and two, the fact that we are continuing to see strong operational performance. In fact, Japanese companies generally reported their best earnings season most recently, where profitability has surpassed the pre-COVID peak. Just conscious of time, just 2 more slides before we open it up to questions. Yeah, I mean, this page, I think, is to further highlight the point, really, in that the sharp and capricious vagaries that we've seen in the market recently, which the bottom chart highlights, can help in one year and hurt in others, is to be expected. It is part and parcel, I guess, of what we ultimately achieve, which is the asymmetry, the inherent asymmetry of equity market returns, where the worst case scenario is not day-to-day, week-to-week, month-to-month volatility. It is key business risk. It is 100% downside in your holdings, but that is more than eclipsed with the potential upside that you can get in returns. Then last page, this is to further hitch that message home, and to highlight, I guess, that the uncomfortable reality of achieving or capturing that upside. It's not all fair sailing. And what we show here is our top 10 contributors, the top 10 within that previous asymmetry chart, and their downside. So their downside, their drawdowns. So the chart on the left, we've extended that x-axis, and you can see that for most of our big winners, at one point or another, they have all lost almost 50%, half their value at one point. But if we put that chart, we attach it to what upside we've been able to capture, it pales into insignificance. So the bottom line, effectively, is that it can be a very, very rewarding strategy. But it's not smooth sailing. It can be very, very uncomfortable, as we're experiencing at the moment, and that can happen from one period to the next. But for those that are aligned with us in terms of their intentions and terms with their patience, we believe that our approach of being long-term patient, bottom-up growth investors will be incredibly fortuitous, incredibly advantageous when it comes to capturing Japan's most promising growth opportunities. And with that, I will stop and open up to questions. Thank you.
Thanks, Thomas. We've had plenty of questions come through already, but if you're in the audience, please do keep your questions coming. We'll try and get through them all. So the first question, you did briefly touch on this in terms of the differences with the open-ended Japan fund. Are there any differences at all in terms of the investment process or the portfolio? And perhaps I could tie in a couple of questions that have come in about unlisted or private equity investments. Does the trust take any of these investments, and if so, to what extent?
Yeah, sure. So first question on differences. There is no difference between the process and philosophy that is adopted across our Japanese strategies. And that's really useful because, as I said, they all benefit from that team-based approach. So an idea can come from any member of the team, be debated by the entire team, and then it might be more appropriate for the trust or the fund or the smaller companies fund. But either way, everybody benefits. The only difference, therefore, is more a reflection of the vehicle. So the trust, the investment trust structure, allows Matt and Praveen to go a little bit further down the market cap spectrum. So there is more overlap with the smaller companies fund and the Shin Nippon Investment Trust. And Matt can also utilize gearing. So at the moment, gearing is about 16% of the portfolio. So you can have more exposure through that way. And of course, there are other aspects that are different because of the trust structure, so the NAV and the discount or premium that might exist. But no, in terms of process philosophy, they adopt the same approach. In both cases, we're trying to capture the asymmetry of equity market returns, utilizing that Baillie Gifford philosophy of being bottom-up, long-term patient investors. But obviously, that is practically applied in slightly different ways to reflect the nature of the structure. Second question with regards to the unlisted opportunity within Japan. So no, it's not currently utilized within the Japanese trust. It's something that the board would have to approve if they wanted to, but there really isn't much of an opportunity at the moment, but that's changing. That is starting to appear. So the Shin Nippon Investment Trust does invest. They have the ability to invest up to 10% within unlisted. They currently have 3 holdings. In each case, they're getting bigger and bigger. So I think that is kind of emblematic of the market, the fact that this opportunity set is increasing. But it's been a fairly small opportunity for some time within Japan, and this really differentiates Japan to other regions around the world. So in Japan, the nature of indices means that it's been very, very easy, and it's been somewhat of a trophy thing, accolade effectively, to list early. So a lot of companies have done that. There aren't the same onerous listing requirements as there are in various European, UK, and US and the US market. So it's been quite easy for companies to list. I think the other reason as well is that there hasn't been as much available risk capital. Banks were the previous provider, the main provider of capital, and banks in Japan are famously risk averse. And so Japanese companies have been forced to list in order to get access to capital. But again, that's starting to change. We've seen a huge increase in CVC, corporate venture capital. Some of the companies in this portfolio, actually Sony is a big provider of capital to new starts, SBI Holdings as well, and Rakuten and CyberAgent. A lot of these businesses are now providing a lot of seed capital to new businesses. So we've seen a huge increase in the amount of private equity capital, and that is allowing businesses to stay unlisted for longer. Because once Japanese companies do list, there is often a shift in focus because market participants require profitability over growth. So a lot of companies are forced to sacrifice that growth potential in order to deliver profitability. So we think the opportunity is changing. We think we'll see more and more unlisted companies stay unlisted for longer. And as that opportunity set changes, so too will this fund to reflect that. And I think it's highly likely that the board will probably provide Matt and Praveen with the flexibility to invest in unlisted companies when that opportunity comes to fruition, effectively.
Great. And you mentioned gearing is currently 16%. We had a question on the approach to that in terms of, is it a long-term strategic approach or shorter term, and how does the trust gear up? Is it through shorter term instruments or longer term debt?
The debt facilities, I think it's a mixture of both. We benefit from the incredibly low rates that exist within Japan. It's more of a strategic thing. We don't try and play the markets. We will take advantage when there is a big disconnect. So we, I think, increased it when COVID occurred, and we've increased it. Matt increased it recently from about, I think it was 12, 13 to 16%. He's done that in the last couple of months because of the huge disconnect we've seen in markets where share prices have gone one way, operational performance continues to be fairly robust. So there is this big divorce from share prices from fundamentals. And so Matt's used that as an opportunity to increase his overall exposure.
Taking a step back to sort of the macro view, I guess one of the themes in Asia over the last few years has been the shift away from China in terms of supply chains as a kind of preferred partner for Western investors and perhaps for Japanese investors. So the question is, are there opportunities for Japan in this increased isolation of China in the global economy?
Yeah, that's a tricky question because if you look at Japan's history, there are very strong ties to the US. Politically, especially that is the case, and in terms of defense, and that's been the case ever since, obviously, the end of the Second World War. But China undoubtedly presents a bigger opportunity, I think, to grow for Japanese companies. So in terms of China's isolation, in terms of picking a side, I think Japan is going to play that very carefully, very politically, to try and keep both parties happy. China, I think, if I were to look at the portfolio and overseas exposure, I think China is probably the biggest single market for a lot of our holdings, be it in robotics and automation companies, skincare companies, sanitary products, snacks and cereals. The majority of these businesses are very reliant on the huge growth prospects over the next 5-10 years that China presents more than any other country. So I think they're going to try and play it carefully both sides. And what's key here is that a number of Japanese companies provide key technologically superior products, which are going to be very important to China's long-term growth prospects. So I think it's in both parties' benefit for this relationship to work. But in terms of, taking a step back and making a call on the broader implications of the changing nature of geopolitics within that region, I think that's a very difficult thing to call, which is why we try and bring it down to the two individual companies and see for an individual company that relies both on China and the US, how its revenue and its growth potential might be upset if there were embargoes and various other trade issues to play out.
And what about Japan as an economy? So we all know of its demographic issues. and it's known for also having high levels of government debt. Is this, is Japan in long-term decline? Does this provide opportunities, or is this a negative for the equity markets?
I think this is the beauty, really, in that every time you read about Japan, it's often peppered with negative adjectives. There's all of these issues around debt, demographics, deflation, da 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 da. The beauty being is that if you are a selective bottom-up investor, you can navigate some of these issues. This is, as I said at the beginning, this is not intended to be a reflection of the Japanese economy. If you want that, it's better to buy a simple ETF of the topics. This is supposed to be a more nimble capture of the companies which we think have significant growth potential ahead, which means we invest in companies that will turn those broader macro headwinds into tailwinds. So taking the demographic one, for example, the labor market within Japan is shrinking by about 600, 700,000 people every single year. That is likely to provide a long-term catalyst, a long-term incentive for people to adopt labor-saving alternatives, whether that be in robotics and automation, and I'll give you an example in a second with the likes of Keyence, or in online software solutions with the likes of Infomart, for example. So taking those two in turn, so Keyence is a company which provides vision and sensory systems for robotic companies. It's a global leader in this on this front. It is effectively the eyes of robots. And they have been able to increase or improve the technological capability of their offering to such an extent that now their solutions expand way beyond what people often associate with robotics and automation. So it's way beyond just car manufacturing, semiconductor, smartphone manufacturing. They, for example, recently helped out a crab manufacturer. So this is a really kind of small illustration, but I think it highlights the dexterity and complexity of what they can now achieve. They have helped a crab manufacturer remove the need to employ 10, 20 people within Japan because they have created these machines which can select and sort crabs based on their size, color, and other characteristics. A job which is quite technical because they're always moving around. It usually, you'd expect, relies on the experience and knowledge of those people that have been picking crabs for 20 years or so. But now the vision and sensory systems of Keyence's machines are able to do that much faster, removing the need for labor, which is obviously in certain pockets within Japan becoming more expensive as well. So it provides obvious benefits, margin accretive benefits to any business. So that's one example. The other being Infomart, a company that connects restaurants with suppliers. In Japan, restaurants usually have about 15 different suppliers supplying various different ingredients that are put together into a menu. Previously, that has relied, or that job has been dependent on 2 or 3 people going to trade shows, communicating to try and find the best prices for changing products in season, etc. Infomart just brings all of that online, and it benefits from a bit of a flywheel effect here because the more suppliers that use Infomart's website, the more restaurants, likewise, the more restaurants, the more suppliers, and so it becomes quite a big beast. Restaurants have been hit materially by COVID, the hospitality sector. Their ability to let go 2 or 3 very expensive individuals because they just can't find the labor will be very, very beneficial to their business. And they're able to do that because they can replace 2 or 3 people by this system. So, I mean, this plays to the Luddite arguments with regards to technology and that it removes jobs. But Japan's a bit of a peculiar situation here because it's a little bit further ahead than other developed markets in that they are suffering from a decline in demographics. Their population is expected to shrink by 20-odd million to about 100 million by 2050. So they need labor-saving solutions. So it actually will provide quite a strong impetus, quite a strong tailwind to a lot of companies within the portfolio. And that's true of other kind of macro themes where careful, clever, flexible, and adaptive companies can turn ostensible disaster into strong tailwind and make a profit from it. And that's why and how we're trying to position the fund.
Thanks. So I think, given that we're going to the lunch break, I'm going to push it a bit. We're running up to time, so maybe you've got a couple of questions we can sneak in. So the first was on the impact of inflation. So you mentioned a bit that Japanese CEOs were highlighting inflation as the number one concern of theirs, if I remember correctly.
Well, so it was a survey that was conducted with CEOs, 3,000 CEOs from across the world, and it was more labor shortages and the related wage inflation. But throughout the world, not just Japan. But yeah, sorry.
Yeah. So I get the question was about how Japan's sort of exposure to this global inflation. Clearly, you highlighted one of the long-term opportunities in automation, but in the shorter term, is the Japanese market or Japanese businesses going to be able to pass on rising costs? Is this a relative to the rest of the world? How does it stand in terms of how it can incorporate this issue?
Yeah, it's a good question. It's something we've been debating, not in the team, not in terms of our inflation expectations, where we think inflation CPI is going to go at the end of the year. We're not trying to do that. What we're trying to do is entertain a reality whereby inflation does come back to Japan and what that means for different parts of the portfolio, effectively to avoid anchoring off the past, and not just the recent past, but the last 20, 30 years of past where there's been no inflation effectively within Japan. And it varies by company, but generally speaking, if we were to see a bit of inflation, it would probably be quite good for Japan, because it would help boost consumption, which would help some of our consumable companies. Consumption has obviously been incredibly low for the past 2 years because of continuous states of emergency lockdowns. Japanese consumers have a huge amount of cash. 50% of their assets are still in cash, which to my last recollection amounted to about $10 trillion in cash. So there's a huge amount of cash, a huge opportunity there, huge resource for them to take advantage of and actually start spending. And they've never needed to in the past. It's been easier to just shove it under the mattress because inflation hasn't been there. But if that does arrive, that could force a bit of change in attitude. So consumption could increase. And likewise for companies, we could see companies start to, or more quickly, address the huge amounts of cash that they have on their balance sheet. So that could result in more buybacks, more dividends, which again could be one of those rising tide events within Japan. In terms of the impact on specific companies, there are particular companies which will probably benefit within the portfolio here. So we do have some exposure to financials like Sumitomo Mitsui Trust Holdings Bank, which is a bank which has more exposure to fee-based income, custodial services, asset management businesses, etc. But it is still exposed to banking, deposit rates, etc. So companies like that would probably benefit. For companies that are currently facing higher input costs, and that's quite a few, where they're having to deal with higher energy costs, imported inflation from overseas. The majority of these have either strong market share or products at low pricing point. And in both cases, or in one, both, or either case, they have pricing power, which allows them to pass on the cost of inflation, of the cost of imports to consumers. And Bridgestone is a good example of that. So Bridgestone is a huge tire manufacturer, about 16% of the global market share, number one player. And obviously is very impacted by the price of oil commodities and obviously the imports that then feed into making tires. But recently they announced that they planned, or that they were going to, I think they may have already done it, but they were going to increase the price of tires within Japan by 10%. And this is unheard of. People have lived for 20, 30 years within Japan and not seen a single bit of inflation. So it's very unusual to get inflation. In fact, when I last went to Japan, I remember speaking to a company that had raised prices and then took out a double spread in the newspaper the following weekend to effectively apologize for raising prices. Like, it's just not heard of. Bridgestone has been able to raise prices 10% because of some of those dynamics I talked about, they have a huge market share, which allows them to pass on the price of higher prices to their consumers, as opposed to having to absorb that into the margins. And so that's what hopefully we would be positioned so well placed if we were to see more domestic inflation rise in the future.
Brilliant, thanks. And I'm just going to sneak in the final question. We began, well, I began by mentioning that the trust is currently trading on a discount, which hasn't, well, sometimes been the case, but it's traded on a premium for a long period of time. Could you just briefly describe what the approach to buybacks is of the board? Do they have a target level, or how would they employ buybacks if they did?
Yeah, so that's at the board's discretion. So they don't have a target level. They try to make sure that NAV, share price and NAV are thereabouts, trade close to one another within single-digit percentages. However, they're not going to try and offset significant short-term swings in the market. The share price, like all other share prices, is very sensitive and exposed to the vagaries of sentiment, which can change quite quickly. And so we're not going to exhaust our powers at buybacks and issuance, etc., over short periods. But over longer periods of time, we would hope and we would try to make sure that the two normalize and trade within a close boundary of one another, or close range, I guess.
Brilliant. Well, thanks very much, Thomas. And thank you to the audience for your attention. Hopefully that was useful. The recording will be available on the site later if you want to rewatch. We now have a lunch break, but I hope that you'll all join us this afternoon for Bearing Emerging EMEA Opportunities at 3 o'clock. That trust has significant investments in Russia until the recent volatility, so it might be quite interesting to talk to them about what's going on there. But thanks once again, Thomas, for a good presentation, and I hope you enjoy the rest of your day.
Excellent. Thank you very much. Thank you.
Bye.